Hey, this is Listen Up Homebuyers podcast, and I'm Victoria Ray Henderson, the host. And I am joined today by Ramez Fahmy of the Fahmy Mortgage Team. He is a lender with First Heritage in the greater Washington, D.C. area. And the reason I want to talk to you today, Ramez, is because I've had some clients ask me questions about something when they make an application for a loan with a lender. And I thought you could talk a little bit about credit triggers. What are they, and why do people receive these credit triggers?
Sure. So these annoying calls that customers are receiving are coming as a result of a lender like myself who's in the middle of, or in the beginning process of getting you pre-qualified or pre-approved for a mortgage. At a certain point in the process, I need to pull your credit report. And what happens is the credit bureaus, and those credit bureaus being Equifax, TransUnion, and Experian, will sell that data to other lenders who are trying to market their services to you. So you receive these unsolicited calls because those other lenders know that a mortgage company pulled your credit. And so they assume that you want a mortgage, and they're going to try and, solicit you, and, it could be coming from anywhere.
Yeah. So how is something like this legal?
Well, as of today, the Fair Credit Reporting Act allows these unsolicited offers to occur, and they're basically called like pre-screen offers. There is legislation in Congress right now to try and get rid of that. That's been going on for the last couple of years, but seems to hit roadblocks sort of towards the end of the process. And most recently, it was unanticipated that would be passed, but it did get passed at a Senate level. But it looks like it's stuck in the House of Representatives and may never get past there.
Oh, gosh. Okay, so what is it? Is there anything that people can do so that they don't get these annoying phone calls? And
Sure. Yeah, there are a couple of things that customers can do to limit or minimize these calls. The first thing is what's called an opt-out pre-screen. We'll put a link in the link below here with some information on where to get that done. There's also what's called the National Do Not Call Registry. Now, both of these things, if you do them online, will sort of save you this hassle for the next 5 years. Otherwise, it needs some written authorization for it to happen permanently.
Written authorization from, you mean from Congress?
No, you as a consumer would have to fill out a form and mail it in versus completing a form online to do so. Yeah.
Okay. So is there anything, when this process begins, which it begins with you, a lender, is there anything that someone can do like you so that the client doesn't receive this stuff?
Yeah. So it's interesting in that some customers will call us and say, hey, you sold my information to this other person. And when you think about it, why would a lender want to create more competition for themselves by selling off this information? And when I tell you calls come in, you could receive from the moment that I pull your credit within about 10 seconds, 50 to 100 phone calls. I've had people that I know who are friends of mine. I warn everyone, say, hey, listen, I'm about to pull your credit. You're going to receive a lot of phone calls as a result of this. So just hold on to my number and save it in your phone. And these calls that you get for the next day or two, now it could last for up to a year, but like the first basically 24 to 48 hours, people's phones literally are ringing off the hook.
So wait a second. So back up. But there's a way to avoid that. And the way to avoid it is get on that do not call registry list.
Get on the do not call registry list. And the other thing is called an opt-out pre-screen. And like I said, we'll drop that information below.
Okay.
You typically want to do that at least 24 to 48 hours before you have someone complete it.
Okay.
But I still don't know that I would guarantee that you're not going to get any phone calls, but my guess is it will reduce the call volume greatly.
So if somebody doesn't receive that information, the opt-out information, you could certainly ask, a lender, hey, could you provide this for me? Okay.
Yes. Yep.
Okay. So when these phone calls start rolling in, other than, ignoring them, is there something that people can do? I mean, I guess just block them?
Yeah, I mean, you could just not answer the call if you don't recognize the number, or you can just kind of politely tell people that you're not interested, and and then, like I said, consider getting on to the that do not call registry and that opt-out pre-screen for future. I would
seriously consider that, because that is, I mean, I couldn't imagine how annoying it would be to get that many phone calls that quickly. And it would be confusing if you had no idea how that happened.
Yes. Yeah. And most of the time, these lenders who are buying these leads are not your sort of like traditional, reliable lenders. They are,
Got it.
kind of, I don't want to use a negative term, but kind of bottom feeders who are just trying
Sounds like
to,
it.
reach out to consumers and just kind of throw a number in their heads. And look, it creates a lot of additional discussions with us. And we have to kind of explain to customers like why you would want to use someone like myself versus someone who's calling you unsolicited.
Yeah, that was so annoying, so annoying. Okay, so while I have you, a couple other questions that have to do with this process of applying for a loan.
Sure.
So I have a lot of people ask me, what is the difference between a soft pull inquiry and a hard pull inquiry? Tell me about that.
Sure. So this is a big question that comes up. I think people in general make a bigger deal about it than it is. But a soft credit pull is sort of like a pre-qualification kind of credit pull. Or if your employer is doing like a simple background check, where a hard inquiry is when someone is applying for credit. So a soft pull generally gives you most of the same data that a hard pull does. It doesn't necessarily pull from all three credit bureaus and cannot be used to make a final credit decision on a loan as of today.
Okay.
What it does is, because it doesn't create an inquiry, one is it limits those calls that we talked about. As far as the credit trigger calls, but then it also doesn't kind of ping you with what people believe is a negative thing on your credit.
Right.
What I tell people all the time is if you have excellent credit, you can have your credit probably pulled as much as you want, and it's not going to impact your ability to get a loan or the terms you're going to receive.
Now, when you say pulled, are you talking soft pull or hard pull?
A hard pull. When a hard pull, people think that, okay, it's going to ding my credit and my credit report's going to drop by 5 or 10 points.
Okay.
I don't necessarily believe that to be the case in every scenario.
Okay.
I tell people this all the time. If you went to Macy's last week and you got a 10% off because you opened up credit, and then you went down the road and got a car dealership to pull your credit, and then you came to me and you had me pull your credit, and then it looks like you're appearing to make multiple types of credit that you're opening, and maybe your credit profile already has maxed out credit cards or things like that.
I see.
That person is impacted more negatively than someone who might have a perfect credit score who's just shopping for a mortgage.
I see.
One other thing to consider in that is if a mortgage company pulls today and a different mortgage company pulls tomorrow, it's going to be treated generally as the same inquiry. It'll show up, but as far as like how it impacts your credit score potentially, if at all, will be treated as a single pull.
Is that because of how close they're being done in time, or because of the nature?
I think it's a combination of things. One is because it's being done in a short window of time, but it's also you're not likely looking to buy two separate homes.
Got it.
Whereas the scenario that I mentioned before that,
right?
You have a situation where someone is looking, like I said, as a retail credit card, car dealership, mortgage company. We're all coded for the type of business that we're in.
Got it. Okay. Is it safe to say that you would advise people not, when they're getting ready to buy a house and apply for a loan, not to go out and open up lines of credit and try to get a car and all these kinds of things? It sounds like it probably isn't a good idea.
Absolutely. And I would also tell them not to close a bunch of accounts as well, because the credit score algorithm looks at the length of time you've had accounts open, how well you pay those accounts, the frequency by which you pay them, and the proportion of balances to credit limits on both individual accounts as well as the totality of the available credit that you have. So closing accounts that have been paid on time can be a negative impact as well. So
that's really good to know.
I think you want to make sure that you're talking to a reputable lender who can give you good advice on the best ways to sort of, present yourself in the best credit light.
Have we covered everything that you wanted to cover today?
Yeah. I mean, the one thing that I would maybe mention is ultimately a lender is going to need to pull a hard pull. So when I have a customer come to me and they are kind of ready to go, looking like they're going to buy a house in the next, 30 to 45 days, that's when I will send them that. I'll always send them the email. I even have it in my email signature now for this opt-out pre-screen.
Good.
To minimize these credit triggers. In that case, I would tell them, let's go ahead and pull the hard credit, right? That credit report is good for 120 days. So long as you close on your mortgage within 120 days of when we pull your credit report, we won't need to pull a new credit report.
Okay.
If you call me today, like I'm having a lot of calls in the beginning of the year, everyone's New Year's resolution is to buy a house this year, but you have some people who are in lease situations and they're not looking to buy for 6 to 8 months.
Right.
I would probably suggest that person to just do, the soft pull, and we can do most of the work that we need to prepare that person for home buying with that soft pull.
Okay. So soft pull is if you've got the long-term goal of maybe, past 3 months, maybe 6 months, maybe longer looking for a house, and the hard pull will last for 3 months. And that's when you're really ready to go and you can buy a home within that 3-month period. And then you won't have to have your credit pulled again.
Yeah. I mean, generally that's accurate. Yeah.
Okay. All right. All right. Ramez Fahmy with the Fahmy Mortgage Team at First Heritage Mortgage. It is always a pleasure to talk to you. I really appreciate you coming on Listen Up Homebuyers. Thanks so much for joining me.
Thank you so much for having me back.
And